Hello traders, and we are going to be doing some daily time frame analysis and hopefully going to be getting into some games later as well. So yeah, we're having a look at GBP/USD on the daily, just testing out a new strategy really. Well, it's a pretty simple strategy where we're going to be using, let me get it up. We're going to be using these two EMAs, 432 and 960. The reason for that is once you go onto the daily, I think it's the daily, it might be the 15-minute, it's the same as, actually I think it's this one. So if you go into the hourly and put these two EMEs onto your charts, it's the same as what it would be on the daily if it were an 18 and a 40. So the reason I'm doing that is, on the daily chart, if you're using an 18 and a 40 moving average, it's super easy to see where the trend is. Basically all it is if the red is below the blue, you are looking for sells, and if the red is above the blue, you're looking for buys. And it's a trend strategy, and that is pretty much all you're doing. Now, you can do this on the daily, of course, but the problem is you have to switch from the daily to the hourly or 15-minute, whatever time frame you're trading. Whereas if you're doing it on the hourly and you just set it to these two numbers, that's the same as what it would be if you were on the daily. I hope that makes sense. So it's a good way of sticking to one time frame but getting the best out of the daily time frame as well. So I can see the trend on the daily, but I'm on the hourly chart, and all I'm doing really is, as you can see here, we've had a switch, and if I'll mark that and we can see what happens on the daily chart. So right there, if we go into the daily, so it's right here. So as you can see, we're on the daily, we are in a downtrend, and we've had 1, 2, 3, 4, and that's the 5th daily candle. And obviously when you've got down moves stronger than the up moves, the EMAs are going to be facing down, and eventually we're going to get a little switch of the EMA going from above the blue line to below, which is where we want to have a look for shorts. Now let me just go onto the hourly, and all you'll be doing is looking for shorts. And whatever strategy you're using, obviously there's plenty of strategies out there, but you can look for fib retracements. You could look for stochastics. If you put a stochastic indicator on RSI, you could be looking to sell in this area here. So in between the blue and the red, you could be taking sells, and obviously round here, these are going to be losers. But once you actually get somewhere like this, like if you took shorts in here and you put your stop loss above, I don't know, 30 pips or something. Let's actually have a look. Let's test it, shall we? So let's say you went short in here, and then you've got a 30 pip stop loss, but your take profit is completely open. So there's no limit to how much you can make, but there's a limit to how much you can lose. And every single time the market came up into that zone, you took a sell. If we just copy and paste, you take one in there, oops, Yeah, you take one in there, you take another one in here. If you wanted to be really risky, you could take another one in here. And as you can see, you've just had 4 losers in a row and a 5th. But then once you get down here, you just copy and paste. You get short in here, and look at where the market goes. Let's see how many pips that is. Oops. Let me try that again. So short in there. You've got a 30 pip stop loss. And let's say you got out once, I don't know, you had a higher high, or a higher low, I mean. Which is, so there's one in here, that's a very, very short term. There's a large one in here, so if we have a look at this. You could use fractals maybe. Let's just get that up, fractals. So as you can see, you've got all these fractals on here. And if we just reduce these a bit so they're a bit better. You could be taking sells when you see a fractal above, and you would not be buying at all. And you just basically hold as long as you wanted to hold, and as long as you could see the momentum of the market. So all the way down here, you can see a really, really strong momentum. And then once we get down to this zone here, so you'd still be thinking that the market's going to go down here, because at the moment, that's all you're seeing. So you're expecting the market to come down here, and then you get a little bit of a pullback, and we break this high here. So that high has now been broken by this one. And right here, you're hoping that the market is going to break these lows, possibly. And obviously we get a little bit, we do get a break, so that's actually a good indicator. And then the market comes up and we break this high again. So let's mark that on here, we break this high. And then we get another move up and we break this high. And then the market starts to come down again. Consolidating, and then we get another touch of this area here, and now we start to move higher, and we break this high again. So I'd probably say once this high is broken, this would be a good area to get out of the trade. And all you do is you would move your stop loss. You'd be trailing your stop loss above all of these highs. So as the market's coming down, let's just get rid of that. How many pips was that? It's over 1,000 pips. And then you've just lost, let's have a look. You just lost 120 pips in here, but made over 1,000 in one trade. And you could be adding to this position all the way down. So you'd move your stop loss once you get this move down here. Oh no, this move down here, sorry, because you're entering here. You just put your stop loss here once we break these lows. And then we get a move down. And we haven't broken these lows yet, so you don't move your stop loss from here. And as soon as we break these lows here, move your stop loss down to here. And then we break these lows again. Move your stop loss down here. And then we broke the lows here again. So move the stop loss here because of these lows being broken. And then we get another low here. And as you can see, you just keep moving your stop loss down. And I mean, you could even move it down to here. And then you'd actually be getting a better exit than if you were just to hold for a higher high. Which is a difference of 13 pips. So actually it's not that much, but no, it's not 13 pips, sorry, 134 pips, which is obviously quite a bit, but when you've got that kind of system that you're following, where you're moving the stop losses from the highs down to the lows, and you just keep trailing it, it's just going to be compounding those winners compared to your losses, because you're going to be having small losses but potentially big wins. And that's all you can do really, is try and reduce the amount of losses that you're having whilst having the big gains. I'm not trading this system at the moment, obviously. I'm not saying that this is profitable, but I am testing strategies at the moment where it's a trend strategy, and that is something that you could do where you just move your stop loss down with the actual highs. But I mean, there's lots of different strategies that you can do on the hourly. A good one is using fibs. So if we move from here and we go into this area here, considering that we're in a trending market, not in this area, but overall we're in a trending market because of the daily and because of these two moving averages, we're still looking for sells. And you wouldn't be taking any buys, so you'd only be looking for sells. So something that you could do is using fibs, but in this kind of range strategy you might have quite a few losses. But something that you could do is, if we just have a look at this is a good example. You could take, where's the rectangle? You could take this high here down to the body. So the reason I'm doing that is, we have a look at this. We've got a big candle wick here, and then we had this move up, and we've had a nice little wick here, and then we had a move down. And the reason I'm doing this here is because this area is a really, really nice area to be looking for shorts. So, I mean, you don't really get a better entry than that. You could just put your limit orders in at the bottom, and then put your stop loss above that high. So you'd have a 15, let's go 15 pip stop loss, and then you could go for a 3 risk reward. So making 45 pips or risking 15. Obviously, when you're having a look at it in hindsight, you can make a lot more, but you don't know that when you're actually taking the trade. So a 3 risk to reward ratio is pretty good. You could go for 5, which would be here. Oops. Here, and again, looking back in hindsight, you can still get more out of that. But a 5 risk to reward is really, really nice. And every single time the market comes up to that area, you could be taking shorts. So you've taken a short in here, and that's a profit. And then, as you see, you've got another one here, and that's another profit. So now you've just made 150 pips without even taking a drawdown of about 6 pips, 5 pips, and to be able to do that is very, very good. And the reason that you're able to do that is because you're combining multiple things. So we've got the downtrend on the daily. You're in this little area here where we're expecting price to reverse, and we've got a nice candle here where price has reversed previously, and we've had the up move, and you're basically just getting in there hoping that the price is going to reverse more. And something that you could do, instead of having a set 5 risk to reward, is you just take your profits once price hits the red EMA. So if you took 2 trades, you would be getting both of them out here. Let me just move that down. I'll just put that there. So you'd be entering both your shorts here and exiting once price hit the EMA, which is a total of 360 pips with a 6 pip drawdown. Now obviously that is looking back in hindsight, and that's not going to happen every time. I mean, here's a really good example as well. So you've got a move up, you draw your little box, price comes up and you enter short here. Stop loss above the high, and you'd be looking for a take profit around this area here where the EMA is. And of course price just goes straight through that level and you have a loss. But the thing is, if you backtest this strategy and it's profitable because you've got these massive winners with limited losses, you can have a strategy where if it's profitable, you know you're going to be profitable because you've got the potential to have a big move. Because I mean, if we have a look at this, obviously it's quite a small zone, but if you've got this zone here and price comes up and retraces out, and then we come straight back up into that area and you take a short in here, and all you're doing is holding until price hits the EMA. So you're not exiting yet, still in the trade, still in the trade, still in the trade, and you would exit here. Now I know what you're thinking. Why didn't you just exit down here? But that's not the strategy that you would be using, because you would be entering where you've had the price up, a reject, and you're getting in again in that little zone between the blue and the red EMA, and you're exiting once price hits that red EMA again. And obviously that is something that you would be able to do consistently, and it's a system that you can follow where there's not much room for emotional trading to come in, because you've only got the most emotional bit that you've got is the actual entering of the trade, and you've got that thing where it's kind of you're entering when the market's moving up instead of when the market's moving down. And there's quite a few traders that wouldn't want to do that, which is understandable. But when you've got the move up and you've backtested and you know it's profitable, and you have a move where you can make 730 pips and you're only risking 30, which is a risk to reward of 25, what trader isn't going to want that? Because I mean, even if we come back here, let's have a look. So you've got this zone here. Price comes down, comes back up, you enter short. Oops. You don't enter long, you enter short. And you've got the 30 pip, oh no. Stop loss above the high, which is 11 pips. Sorry, you're not even risking 30 pips. Which is a loser. And you would basically do that every single time. You wouldn't even think, because I'm not saying this is a profitable strategy, it might not be, but if this was a profitable strategy where you were taking sells and buys in this zone here with a candlestick like this, you know that if you lose, you're only going to lose 11, 12, 15, 20, 30 pips, but you've got the potential to make 700 pips when you're correct. Is that not a good trade-off? It's a pretty good trade-off if you ask me. So test your own strategy and find the strategy where you can potentially have massive upside with very little drawdown, very little losses. Because when you actually find a strategy like that, and you've backtested it and you know it works, you're going to have the confidence in that strategy to actually just go and take every single trade without any emotion coming into it, because you've done the actual backtesting and you know it's profitable. So if you are testing a strategy, put the time in to actually learn. So yeah, I've just read the comment by Renko saying that the stops are too close, but the reason that the stops are close is because you've got that window where that's the actual area that you're expecting price to come into, and if price breaks this high, personally I would be expecting price to move higher, and that's the zone where I'm expecting price to reverse. Now you could enter at the 50% level, so if we just get a little Fibonacci in here, I know that that isn't 50%, but if you just guess where 50% is, I'm guessing it's probably around here, and we just get rid of the fib, you could have a bigger stop loss. So if we have a set stop loss of 30 pips, 30 pips is quite a big stop loss to have if you're trading something where you want price to reverse instantly. And with this strategy, you don't need something where it's just set. So if we have a look at this one over here, what the strategy is putting it above this high, above the most recent high. And here you've got 15 pips. So for example with this one, you've got 21 pips. And all you're doing is looking for the high to not be tested. Because if the high is tested, then price can move higher. And obviously having a look at this one, price then reversed. But you can have the potential of getting large trades. Yeah, so Renko, that's perfectly fine. Like, I'm not saying that this is a profitable strategy. I'm saying that this is a strategy that you could backtest. And if it's profitable, then it's profitable. But if it's not, then you tweak it and you adjust and you change things to where it could be profitable. The thing that I'm testing at the moment is this EMA strategy. So all it is I'm not sure if you were at the start of the stream, if you were in here, but the EMAs are 18 and 40 EMAs on the daily chart. But all I've done is change them so that it shows me what the daily EMA is, but on the 1 hour. So I don't need to switch between the daily and the 1 hour charts. So that I know where the trend is going, and I know where to take buys and sells. And basically all it is if the red EMA is above the blue, you're looking for buys. And if the red EMA is below the blue, you're looking for sells. And that's all it is. Right, okay, yeah. So the reason that I don't do that is because once I know where the trend is going on the daily, I'm looking for the setups to occur on the 15-minute and the 1 hour. And all I'm doing is basically testing strategies to where I can find a profitable strategy where I've got small losses and the potential to have large winners. And if Renko's got a strategy where it's actually profitable, then that's perfectly fine. And there's not one way to trade the markets. If Renko's got a strategy where it's profitable for him or her, I don't know, it's not my job or place to say that you should trade a different way, because I might trade the same strategy as you and it might be a loser, because the way that I trade it might not be the same the way that you trade it. So everyone needs to find the strategy that they're comfortable with and that they're happy to trade with and that they've found to be profitable for them. So put the time in to actually test the strategy that you're doing and backtest it. And if you actually find the strategy where it works for you and you're comfortable taking the trades, then just stick with it. Because obviously there's so many different variants of... Exactly, there's many ways to skin a cat. There's a bit of a gross analogy to make, but sure, we can go with that. Yeah, there's many ways to trade the markets. And just having a little bit of a look, this is a very simple strategy that I have been using for a very long time now, which is the 70% fib. And all it is you're going from you're not using the wicks, so you're not going from this high or this high, you're going from the actual bodies of the candles. Now you could just come over here and do it on this one, like that's perfectly fine, but I would normally do it from the most recent move down to the most recent move up, and all you're doing is putting a sell limit in here, and your stop is going either above this high, which is the most recent high of this move down, or you're putting it at this level here. And obviously you would have been stopped out here, but you can just put it at that high, which is perfectly fine. And then let me just go in here, and if we find the -1, you're putting your take profit at a symmetrical move. And the reason for that is because you've got this move here. So from the high to the low is the same as from the low to this move here. And you're looking for a symmetrical move. Then that's something that you can do on any time frame. And it occurs on a weekly, a daily, hour, 15. And it's something where you can choose the time frame that you trade pretty much. Because you can trade, if you know that you're going to be busy for the next week, 2 weeks, you can just go onto the daily. Let's go onto the daily now and see if we can find a setup. So this seems like a setup in here, possibly. You would have had a loser here, so let's show this one. Obviously you're not going to win every single time, so I'm pretty sure that most traders would say that this is a downtrend, and if we zoom out, this is a downtrend as well. So what you would be doing is placing the stop loss above the high. So you'd enter short here, and also it doesn't matter on how many pips you use, you're still risking the same percentage of your capital every single trade. I personally use 1%. You can use whatever you want. Oops, that's a long position. We're not going long, going short. And you basically put your stop loss there, so 97 pips. And then your stop loss, or your take profit, sorry, would be down here at 310 pips. Now that is a 1% risk. So it doesn't matter how many pips you're doing. You could have pips, oops, you could have what is going on? You could have a stop loss all the way up here, and that would still be 1%. But yeah, so that's 1%, and you'd be making 3.1%, almost 3.2% for the trade. And that's all you'd be doing. So if you're in a downtrend, you'd be looking for 70% fib retracements to go short. So let's see if we can find a profitable one now. This could be one, I'm not sure. So let's just get rid of this one. Okay, so this is a good example actually. So you'd be getting in short here, and your stop loss could either be here or here, and then your take profit would be down here. And looking back in hindsight, that's a losing trade. But something that I like to do with every single trade I do is once you've moved away from that actual entry, move your stop loss to break even. There's no reason not to move your stop loss to break even. It covers the position, it covers the potential of a losing trade. And if you're winning, if we just come back, actually let's use replay. Wait, what the... Why can I not do that? Okay, I don't understand why I can't do that, but let's say you're here in the markets. I mean, I would even move my stop loss to break even here, or even here. So once I get this move down, I'm confident that trade is going to be a winner. So what I would do is move my stop loss to break even, and possibly even take 10% or even 30% of the position off, scaling out of the position. Because I know that once I've moved a little bit, I'm taking 1% off pretty much, and that's basically to just cover the stop loss. Because if you're taking 1% off, this trade here that you've just had that's a loser, it's not even on the account anymore, because you've just taken 1% here, which is hopefully going to be a winner. Obviously it isn't, but you've taken that 1% and you've covered your losses. And if you do that consistently, taking the 1% and leaving the rest on, over time you're going to be profitable, because you're giving yourself the best chance possible to be a winner. Because if you're taking, so I can see a winning trade right here. Let's just plot this onto the charts. And once you trade this for a while, you just see the setups. It's so easy to just see the setups once you've actually used them. So right here, you're around this area here, move your stop loss to break even and take a third of the position off. There's no reason not to. And it's building the account slowly. I mean, even down here, so we've moved past this level here. I would be taking, let me show you this. So we've had the move down. I'd probably be taking 1% here. I'll make that thicker for you guys so you can see it. So, well, that's not a good colour. So taking 1% of the position off here, then taking another 1% once we break this low. So now you should only be risking 1%. Well, you're not even risking anything, but you know what I mean. You've got 1% left. So this is, let's see how many pips this is. So you've got 40. No, that's not 40, is it? $400. You got 400 pips left of the position open, and you've already secured 2%. So once you've already secured the 2% of that trade, you don't care whether this is a winner or a loser, because you've already moved your stop loss to break even, and you've already got 2%. And you can do whatever you want with the rest of that trade. You could just leave it on and see what happens. And obviously you do get tagged out in the end, but that's not the point. You've already secured 2%. So I've just seen the comment, what about oil? I don't actually trade oil myself. I trade Forex, and these are so I trade GBP USD, Euro USD, Euro JPY, NZD USD, and AUD USD. They're the pairs that I trade, because I think that if you trade too many things, you can't actually learn about those pairs. Like, from the trading that I do, it's better to be an expert in 1 or 2 and be good at 5 or 6 maybe, than be average at 20. Because I see a lot of traders that have every single Forex pair and then commodities and stocks, and excuse me, it's not good for actually learning how to trade because you're doing too many things. So when you're actually trading, limit yourself to how much you can actually trade, because that way you become an expert, and the experts get paid more than average people. That's just how it works. So if you become an expert in oil, let's say, you will be an expert in making money consistently on oil. Now I'm sure that there's, well, I know for a fact there's lots of gold traders, there's lots of oil traders, and there's not many traders that I know personally that are experts in 1 or 2 currencies. And I think that that's somewhere that, or something that a lot of new traders should do. Now I don't know how long you guys have been trading, of course, but if you're new to trading, and I see new to trading pretty much anything less than 2 years, just stick to 1 or maybe 3, maximum of 3 currency pairs or stocks or commodities, and just trade them every single day and backtest every single day on those pairs or commodities, and just learn as much as you can about those specific things. Because the more you learn about a specific thing, the better you'll be at it. And considering that there's a lot of numbers thrown around, but considering that 95 to 98% of retail traders lose money, why continue doing what everyone else is doing? You need to be doing the opposite of what everyone else is doing, or what the majority of traders are doing. And what are the majority of traders doing? They're trading 15 different things. They're searching for the magic strategy online, and they're not actually sitting in front of the charts, testing, backtesting, learning, and sticking to their own strategy and learning how to trade their own strategy better. I'm not saying that you need one strategy to be successful. You can have multiple strategies, but find the strategy that you like and just stick with it and just trade it so that you learn how to actually trade it profitably. Learn, if you take 100 trades, what's the percentage of you being profitable? Now I'm sure that there's not many new traders that are going to know the answer to that, but I don't see why, because if you're willing to put money into the markets, and I'm sure that there's lots and lots of traders, 99% of traders, wanting to do this to make money, and they're not doing it because they get fun out of it, although it can be fun, but they're trading to actually make money, is what I'm trying to say. You need to actually put the time into develop your own strategy to where you understand it 100%, and you understand the ins and outs of every single bit of your strategy, and stop moving around to different strategies, because it's just not going to help you. Find the strategy that you like and just stick with it, and just learn every single thing you can about that strategy. So how does your strategy compare to GBP USD versus Euro USD? Which one's more profitable? What about Euro JPY against AUD USD? What kind of what should you be looking for on each of those pairs, currency pairs, compared to the other using the same strategy, because different currency pairs move in different ways. Now, they might correlate in some way, but one might move slower than the other, one might consolidate more than the other, one might follow the other one. Now, if you learn about a few things really, really well, it gives you a stronger chance to be in that top 5% or top 2% of traders that are actually making money. And when you get to the point where you can make consistent money, you can reach out to investors. And instead of making, I don't know, a couple £100, a couple thousand, you could be making 10 or 20k every single month because you're trading 100 or 200, maybe even £1 million account, depending on where you go. I know that there's a lot of prop firms that offer traders 100k, and if you're making 5-10% a month, which is very, very good, but if you're making in between that kind of range of 5 to 10% a month, you're making very, very good money, and you've done it by putting in the work. And you're not going to be able to get to the point where you can make that kind of money without putting in the work. Like, there's no shortcuts in Forex trading or trading in general. You need to put in the work, and you need to sit down and learn. That's just kind of how it is. You get paid to learn, pretty much, and you get paid to be disciplined and patient and follow your strategy. And you don't get paid to be in, or I suppose you might, but you don't get paid to be in communities, and you don't get paid to flash Lamborghinis or Rolexes or whatever things you can buy with Forex. You don't get paid for that. You get paid by sitting down and trading the markets consistently. And you're only going to get that by putting the work in. So find what works for you and practice every single day. Put in the work every single day, and eventually it will pay off. And it might be 5 years. It might be 10 years. Depending on how much work you put in, and depending on how disciplined you are, you'll get different results. Now, there's a lot of new traders that come into the markets where they're expecting to just make money instantly because they're doing what I'm doing right now, and they go back in hindsight and they find the perfect trades where they're going to make £20,000 on a trade on a £1,000 account. And it's not worth it. Just stick to your own thing, stick to your own strategy, and eventually you'll become profitable. And especially if you actually put the work in, because most traders don't put the work in. If you can learn how to be profitable in trading, then it's something that can give you a good income and the lifestyle that most people want. So if you're trading the daily charts, for example, you might be trading for 30 an hour every single day, and you could be making 6 figures a month. Now, I mean, that's obviously a perfect situation for a lot of people, and that's obviously the dream for a lot of people. But the thing is, if you work at it and you stick with it and you learn, then you can get to that. And especially if you do something like FTMO or 5%ers or one of the other prop firms, and you pass one of their challenges and you trade your strategy every single day consistently, you can get funded accounts from these guys, from these prop firms, and make good money. You don't need to be funding the account yourself. There's people out there that will fund the account for you, and you just split the money. And obviously you're not going to be getting 100% of the gains, but you're not risking any of your capital. So it's something that a lot of new traders don't think about when they should. Because obviously having none of your capital at risk, but being able to make money consistently through a prop firm or a private investor is something that a lot of traders aspire to do. And do I trade for a prop firm? No, I don't. At the moment I just trade for myself, but it is something that I'm looking at in the future. I know quite a few guys that trade for a prop firm. I also know quite a few guys that trade for investors, as in private investors. And if you're trading for private investors, obviously there's a lot more legal things that you have to go through, but you've got access to more capital. A lot of the well-known prop firms in terms of FTMO, 5%ers, you have to trade by their rules and you have to trade their capital. So you couldn't go to, well, I don't know, you might be able to. I don't trade for them, but I can't imagine that you'd be able to go to them and just ask for more capital, because that's not something that they would do. I don't know if that is correct or not, but if you trade for a private investor, it's something that you would be able to do. You could go to them and say, look, I've got these results for you, and I'm confident in the strategy. I hope that you've seen that the strategy works and it's profitable. How would you feel about giving more money? And you can slowly build up your capital to where you're trading a few million or whatever capital that person's willing to give you. You can trade that and you can build it up, compared to where the prop firm, you're most likely not going to get more capital from them. So if you are trading your own funds but you are profitable, have a look at a prop firm, and it's a good way to get a large amount of capital that can also feed off into private investors. Because if you trade for a prop firm successfully, you could go to an investor and just say, look, I've traded this with this prop firm for a year, 2 years, here are the results, this is how much I've made, and see if they're willing to give you some of their money. And of course you're probably going to get a lot of no's, but I'm sure there's going to be one investor out there that's going to say yes, and when they do say yes, they might give you a few million to trade. And going from a regular retail trader that trades 5, 10, 20k, 50k, whatever, but then jumping to 100k for a prop firm, and then jumping to a million, 5 million for private investors, it's very good, because you're not only are you gaining experience and you're gaining contacts, but you're gaining the life experience of actually dealing with large amounts of capital. And if you're trading for investors, you need to have almost like a business plan. So not only are you going to have a trading plan, but you're going to have a business plan for them. And once you start getting in the realm of business and large amounts of capital, you start to develop that mindset of you can do most things in terms of business, and you're going to develop the contacts, you're going to develop the business mind that can lead on to other things. And all of that has just come from you deciding that you want to put the time into learning how to trade, and putting the time into actually developing a plan and trading the plan, backtesting the plan, and creating a profitable record, or a profitable, track record that you can show to investors to get capital. I mean, this live stream's gone a bit off track, but yeah, it's good to have a chat and see what's going on. I mean, we're only on GBP USD. There's still 4 more currencies to go through, so we'll see what happens. And as I said before, this isn't trading advice or anything. This isn't me saying this is a profitable strategy. I'm still testing a strategy at the moment because I'm looking to join a prop firm soon, and the current strategy that I'm using isn't going to be something that they're going to like it's not going to be something that they're going to be happy with because of their rules. So I don't think that I'll be able to trade that strategy. So I'm currently developing a strategy at the moment, and that's basically what I'm doing right now whilst chatting to you guys. So if we just go onto Euro USD, I really like Euro USD just because of this, pretty much. This really nice trend. This has been going on for, a year pretty much. So once you find something like this, like I'd say, let's find the vertical line again. Probably around this section here, maybe a bit less than that. Probably around here. This is where I would be thinking that a downtrend could form, because you've got nice lows, you've got really nice moves to the downside, and you've got quite small moves up. You obviously had this move up, but it's moved down eventually. But you can see that for a long period of time, many days, you've got really nice Fibonacci setups. I mean, if we just go through here and find some, it's not going to be hard to find really good setups because we're in a trending market. Martingale. Yeah, I haven't really had a look at that, to be honest, that strategy, but it's something I've heard in the past. But I think it's quite a risky strategy, if I'm correct. I'm not too sure because I haven't really had a look at it properly, but I think what I've heard is it's quite risky. If you can correct me on that. Don't do it. Yeah, I've heard it's quite quite a risky strategy. But yeah, back to this anyway. The strategy that I would be using in a trending market is the Fibonacci one, because if you think about it, what is a downtrend in terms of most definitions? You've got the lower thing here, then you've got a lower high, and you're basically excuse my language. You've got this going on. So you're not breaking these highs at all on any of these trends. And if you do break a high, let's just pretend I didn't get on there. If you do break the high, then you're not looking for trends anymore. You're not in a downtrend. I mean, you might be in a downtrend, but you're, for the short term anyway, this is the new low that you'd be looking for, possibly to break this high, and then you're in an uptrend. But as soon as you break this high, then I'm not looking for anything until we start to move down again. So the idea of the Fibonacci is you're buying or selling, in this instance, around these peaks. And of course, let's just move over here a sec. If you're in this market here, and let's say that looks about right. So you entered short in here, and I'll get onto where the take profit is in a sec. But let's say you get a little move here. Now that's not going to come up to my 70% level. That's quite a way until it hits my 70%. And that's a trade that I would miss. But that's fine, because you're trading your strategy, and you know that if you enter on this here, you've got a good chance of breaking this low here. And there's lots of ways that you can take profits around this level. I'll go over that in a sec, but you've got the confidence that the market isn't going to come up and break this high, because you know that if it does break the high, there's a good chance that we're going to go into an uptrend instead, or we're going to consolidate. That's so messy. So and then we're going to consolidate for a little bit, and then we're either going to break higher or break lower. And then this is the area where I'll be looking for a break lower, and then we're back into that trending market where you're taking the shorts. Or in the up case, you're looking for the Fibonacci for the longs. So if we just go back to the charts, so you're in a downtrend. So let me just get rid of the line here. So seeing how we are in the daily chart, the wicks is where I'm going to be placing the Fibonacci. And this would be an entry that I'd be very happy with. So this would be the candle that I'd be entering on. Stops would be at this high. Now for take profits, I'd be looking to break this wick. So if we just draw that out. Now there's still room here that you can get profits. So if we just move this down, we're already at 180 pips. Now that's pretty good still, but there's still more to gain in that. So if we have a look at this, there's a really nice indicator that I use, which is round numbers. Oh, of course you can't see that because it's bloody... Right, let me get a horizontal line. So the closest one to here is the 1800 mark. Which is in here. Now, you've got that space here. So I'd move my take profit here. And around the numbers, I would look for 20 pips past this area here. So if we just get 20 pips, that is here. Let me draw Fibonacci. Not Fibonacci, sorry, a line. And that's the take profit. So that's how I would calculate the take profit for this strategy. And this is like my go-to strategy for trading. Super easy to do. It's something that can work on all time frames, and I've got confidence in it because I've tested it. So in total that's 290 pips. And let me do this. Oops, that's not what I wanted to do. So if you were to take profits at that low, at the red candlestick that I'm marking from, you've basically got a 29 pip range. And those extra 29 pips is something that can add, in the long term, massive amount of compounding to your account. And if you just do that, so this is something you can add to any strategy, right? Look for round numbers and add or take away 20 pips from that, and place your take profits at the 80 marks or the 20 marks. And if you can do that consistently, it's something that can add to your it can add to your overall account balance massively, because you're getting those extra little pips, extra little percentages, and over time those little percentages compound. So we've taken that trade and we've had a little retracement up in here. You could trade the retracement up into this area here, but you've just taken a trade. So you could do it, you could not. I mean, I probably would, just because it's on the daily chart. If it's something like the 15-minute, I probably wouldn't. But again, same thing. Stop loss at this wick here, or candle, take profit at this low. And then all we're doing is moving this down. What's the nearest round number? It's the 1300 mark. Wait, what? Okay, it's about there. So then 20 pips past it. And all we're doing is marking 20 pips. Which is about there. And that's all you're doing. Pretty much every single time you get the retracement. And that would be a profitable trade. And then this one. You just keep doing it. You'd be entering short here, stop loss here, and you would have been taken out. That would have been a losing trade. And here's a good example like I was on earlier. So we've had the retracement, we've had the move down, but price didn't come up to that area where I'm looking to enter. That's fine. You just move on to the next one. And then bang, entry right there. And that's how it's like, I mean, you've got 3 entries right there and 1 loser. Obviously that's looking back in hindsight and all that kind of stuff, but you're getting very, very nice entries where you're risking 1% to make, what's the risk reward? Almost 3.5, almost 4 on that one. So you're risking 1% to get an average of 3.6, I'd say, which is really, really good. I'm aiming for anything above 3. So yeah, that's kind of the daily kind of strategy that I'm using, and that's the kind of go-to strategy. So yeah, I've just seen the message from Renko saying that he uses 50 and 61.8, and is that because that's what everyone else uses, and that's just something that you're doing because it's what everyone else is using, or is that because of obviously the Fibonacci numbers itself? Because obviously there's a lot of traders out there that are using Fibonacci, but they don't actually know where it originated from, the numbers around it, and they're just using it because they're the base numbers. Because obviously I've changed mine to 70%. And I didn't do that myself. I learned that from another trader. But it's something that I've used and found success with, so it's something that I keep using. But there's a lot of traders that don't do that, and they just stick with the base things. Let's change this music. I might just keep this on, to be honest. A bit repetitive, but I mean, trying to find non-copyright music is a nightmare. I need to try and find some, to be honest. Okay, so let's just go on to the next pair, Euro JPY. Let's have a look at this and do some analysis on this. So yeah, here we go. This is, let's just delete this. So this is a trade. Move that up. That I was having a look at last week, and yeah, it's moving in the right direction. The take profit isn't relevant. That's just kind of where I've just dragged it to. There's a recent low in here that could be, but then there's also one here. So that's the kind of trade that I'm looking at for this week and also next week, which is a really, really nice trade. Yeah, the reason I put the Fibonacci here is just because we had the touch here, and entering where it's already had a really, really nice projection. I mean, entering there would have been perfect, and I would have exited the trade here, like I was showing previously. So that's something that is really, really nice, but this is kind of second best. But something I don't like to do normally, and that's why I've got a really, really tight stop loss, is re-entering Fibonacci trades once that level's already been broken. So normally, once this trade has gone down, I wouldn't be looking for Fibonacci trades unless it's from this high to this low. Because once this is broken, this high here, it's an indication to me that we're going to be moving higher. But seeing how this is such a good downtrend from Feb 2018, it's kind of a trade where you can't miss it because of the risk that I'm having here of 30 pips is nothing compared to breaking these lows and getting 330 pips. I mean, it's risking 10%, it's not risking 10%, risking 1% to make almost 11% on a single trade, which is really, really good. And that's much better than a 3-to-1. But all we're doing is the same strategy as I was before. Fibonacci into that 70% level, but just taking out that low. So let's just do some. I'm gonna wrap up the stream. I might be doing another gaming session next week, but something's come up, so just gonna be going over NZD/USD and AUD/USD, and then just closing the stream. So I hope you've enjoyed it. I'm glad to see you guys coming in and having a little chat. But NZD/USD. We're in a kind of consolidation at the moment on NZD/USD. There's not much that I'm looking at because of this zone here. Now, this, I don't like to see this with a Fibonacci setup. I mean, I like to see the trending markets like we had on Euro/USD, that was perfect, and Euro/JPY. This is not something I like to see. And a strategy where you can do something like this is take shorts in the kind of upper area. So taking shorts in here, going on to the 15-minute time frame or the hourly time frame, and just looking for shorts in this area. Looking for, I mean, the 15-minute is really, really good. Looking for Fibonacci setups for shorts only in that grey box. And what you can do is look for buys on the 15-minute, Fibonacci buys in this area here. And all you're doing is trading from zone to zone. Super, super simple. I mean, I can already kind of see one in here. It might be better on the hourly. But if we just place that here, down to here. Obviously the hourly would give you a much better entry, and it'll probably be somewhere around here because of this large candle. But you'd be entering around here, and you'd be taking the market down to these lows, which would be a very nice trade. And then you'd be buying around here to take it back up to these, and you could be short right now. let's just say you got in probably around, I'm saying you probably got around here, and your stop loss would be here. Actually, depending on what broker you used, you could still be in this trade. I mean, depending on the spreads, of course, and all that kind of stuff. I'm not going to go into that, but you could still be in this trade, and you'd be having to take profit down here. So I'll keep you updated on that. Make sure to join the Discord community. I'll just post the Discord into the chat right now so that you guys can join. And I'll be posting these setups and basically keeping you guys up to date on these trades that I'm showing, and just showing basically the progress of the trades, having trades updates, trade setups. If anything comes during the week, I'll be posting it in there. So make sure you hop over there and join. The next one is AUDUSD. Now this is a sell, if I've ever seen a sell before. Like from a January 2018 trend down like this, we've had a really nice, oh, let me get this, oh, geez. So in here, and let's draw an order block in here from here to here, and sell in there. So I mean, because of the Fibonacci, this is another way. Okay, let me go over this. So if it's a small range in terms of the amount of days, excuse me. So if we just draw this out from here to where we are now, that's over 146 days. Now that's a massive amount of time. So when it's a Fibonacci like that, I'll be looking for a zone. And a really nice way to find a zone is a turning point around the Fibonacci and drawing the zone out to where the most recent candle before the drop happened. And all I'll be doing is entering short at the 50% level of this zone. I hope that makes sense. And then stop loss would be above this high, because I don't want my stop loss to be too big. And then bang, all the way down here at these lows. And that's the trade. You'd probably be holding that for another 3 or 4 months maybe. But that's a really nice trade. 11 risk reward, perfect trade. Once we break these lows down here, moving stop loss to entry, and slowly starting to scale out of the position. Scaling out of the position is something that I think every single strategy needs. So make sure that you do that, because you don't want to let profits disappear. If you can scale out of a strategy, that's really good. So yeah, that's going over all the pairs. I'll be posting these into the chat. Make sure you join and say hi. Yeah. Thanks everyone for popping in. I hope you've enjoyed the, oh, a bit of a delay there. I hope you've enjoyed the live stream today, and I will see you next week for the next live stream, and I'll also see you on Thursday. I've just done a podcast with Etienne, who's the owner of Design